Welcome everyone, this is George Antone and I'm excited about this masterclass. It's called Hacking the Game of Finance for a Better Life. Here's my promise to you. After going through this masterclass, the way you see the whole world of wealth building and investing is going to completely change. And so stick all the way to the very end and watch what happens to the way you think, and you're going to be able to see things from a whole different perspective. Now, for the people that have seen the movie Matrix, you will experience something very similar. And what I mean by that is, in the movie, the character finds out that there's a different world, and he's living inside the Matrix, inside the system, if you will, the computer. And he's able to step out and look at the big picture. And this is what's going to happen with this training. You're going to learn how to see the way things look, the matrix, if you will, for the game of finance, and how to use it and change it to work for you. So I'm very excited about sharing this. Let me start with a question. How would you feel if you woke up one day, 10, 15 years from now, and realized that everything you know about investing and everything you've been doing about building wealth is incorrect? Think about that for a second. How would you feel? You're running around doing all this stuff and you realize it's based on false assumptions. When would you want to know this? Obviously, the answer is right now. And that's what I'm trying to do with this masterclass, is really to expose a number of things that a lot of people have that are incorrect. And I'm going to give you some formulas to write down. So make sure you pay attention very closely, because like I said, I'm going to open up your eyes, and I'm just going to do that. This masterclass was only meant to be for opening your eyes and shedding light to what's happening, but just the tip of the iceberg, because that's all you need right now to realize how much of a change, how much of a shift that's going to do for you. So again, I'm about to give you a small glimpse into the game of finance where you are their biggest asset. You are their biggest asset. And I'll talk about who there is in a second, or a little bit later. So the objective of this masterclass is to open your eyes to the reality of the game of finance and how to hack it to work for you, to move you to your financial goals much faster. Again, all I want to do here is open your eyes and shed light on what is happening and what you should be aware of. Now, I see this happen a lot. Many out there are making costly mistakes due to lack of understanding and seeing the real world of money. And I've seen people losing friends and family's money. I mean, think about it. I met this one gentleman in Florida that lost something like $1 or $2 million from friends and family's money within few years, and all the properties he used to buy them. And the reason is there's a lot of things he did not understand. He just thought it was about buying assets, and that's not the case. And the biggest problem for most people is they think they're moving forward, but they're actually moving backwards. I see that happening all the time. People are investing, people are doing certain things, people are following what's out there, and they're actually moving backwards when they think they're moving forward. You'll see what I mean by that a little bit later. So before we jump into the masterclass, let me share with you really quickly my background, who am I, and why you should listen to me. So again, my name is George Antone. My background is in technology. I used to work for a software company, Intuit, makers of Quicken and Quicken Financial Planner and QuickBooks and all that stuff. Also worked at a number of software companies, including Microsoft. But in 2001, I walked away and I got into real estate investing, and I got into apartment buildings. I got into private lending, ran a fund, and did some residential investing, and raised millions and millions of dollars for different investments, including things outside of real estate. So that's my background. But the question is, why should you listen to me? So I could tell you I'm the author of 2 best-selling books, actually 3 right now, but you know what? Who cares? I could tell you I've been a radio host on the Wall Street Radio Network, but you know what? Who cares? I could tell you my company has made Inc. 500 several years in a row, but you know what? Again, who cares? I could tell you I'm the founder of the largest network of private lenders in the world. But you know what? Again, who cares? Here's why you should care, and here's why you should listen. Because this information I'm about to share with you can be the difference between success and failure in your investing career. And that is so important. In fact, one of the things you'll find out is a lot of this stuff can be applied to non-real estate. It can be applied to non-heavy investing. It can be used for basic personal finance to help you move towards your financial goals. Very powerful information. So, are you ready to get into the matrix and get a glimpse into the matrix? So we're going to do that right now. I want to give you so much content right now. And so I'm going to walk you through a number of scenarios, and I want you to really pay attention here, because it is in these details that you'll start getting exposed to what's going on in the matrix. Again, when I say matrix, I'm talking about the financial system, the way we think it works, but the way it actually works, and how you should be thinking, and how many people out there are thinking incorrectly, and shift the way you think. And again, I'll be giving you some formulas later to prove a lot of the stuff we're talking about here. So with that, let's jump into the matrix. Now I'll be using the term debt millionaire. Write it down, debt millionaire, for people that understand how to use the financial system to work for them, people that understand how to shift the whole financial system to work for them. They are essentially, if you can think of them as people that know how to make the whole, like I said, make the whole system work for them. Debt millionaire is someone who uses this information to strategically build wealth. This information, you'll find out very specific information to strategically build wealth. Again, the debt millionaire knows how to elevate their game so they are in alignment with the system. And what I mean by that, you'll find out more about it later, but I'm going to just tell you a little bit here. The system, or the financial system, is working against us. So we are trying so hard, and every time we do something, it moves us back. So the debt millionaire changes all of that so that we are actually in alignment with the system, so that the system, as the system works a certain way, we build our wealth. So I want to start by saying that the debt millionaire and the investor think they're saying the same thing, but the debt millionaire sees things a whole different way. Debt millionaires see a lot more than investors. In fact, I'll expose you to some of it right now, and there's a lot more. But it's so important to realize that we are seeing, as debt millionaires, things a lot more differently and much more information than investor. So let's do that right now. Again, this year we're going to go through a number of scenarios. Please follow with me, and if you need to, get a calculator, because it's so important that I start showing you what things look like. Let's start with scenario number 1 here. You have $10,000. You have this coffee there that's got $10,000 as well, and the coffee represents any product or service. It doesn't matter. So you can buy this coffee for $10,000, but also you can buy this income producing asset. Now I just put gold bars there, but it's income producing, okay? And let's not worry about the income for now, but it is income producing. And this asset we can buy for $10,000 is supposed to keep up with inflation. No matter what inflation is, it keeps up with it. So now you have an option of buying the coffee or this asset. So we decide to buy this asset. After a few years, inflation has doubled. So therefore, the coffee now is $20,000 because inflation has doubled and it kept up with inflation. The asset also, which we said keeps up with inflation, is now $20,000. So now we have an asset that's $20,000 and the coffee that's $20,000. The question is, can you buy the coffee now, given that it's $20,000 and the asset is $20,000? So obviously you have to sell the asset to buy the coffee. Can you buy the coffee? So most people would say yes, but the answer is actually no, because you have a gain of $10,000 because the asset went from $10,000 to $20,000. You have a $10,000 gain, which you have to pay taxes on. So after paying taxes of $3,000, what you're left with is $17,000, which is your profit and your initial principal of $10,000. So you have $17,000 in your pocket, but the coffee is $20,000. Can you buy that? So the answer is no. So what happened is your purchasing power went down. Your purchasing power went down. So you made money, the $7,000, but what you could buy for it actually went down. So you can buy less. And that's what's called purchasing power. So again, your purchasing power went down. So after taxes, again, you cannot afford to buy the coffee. Let's move on to a pop quiz here really quickly. If you had not purchased the asset nor the coffee and kept the $10,000 with you, and knowing that the asset now is $20,000 and the coffee is $20,000, what would have happened to your purchasing power with the cash? Obviously, it would have dropped quite a bit. So just holding on to the cash wasn't a good idea either, because it would have gone down in purchasing power. So with that, let's move on to scenario number 2. So you still have your $10,000. You can still buy the coffee for $10,000, but instead what you decide to do is you decide to buy the asset, but you decide to buy 2 of them. And again, you borrow money, $10,000, and your $10,000 principal, and you buy this asset for $20,000. So now you have this $20,000 worth of assets. You have $10,000 in debt, and your $10,000 in from your principal, and you buy this asset that keeps up with inflation. So after a few years, again, your coffee or inflation has doubled. So now your coffee is $20,000. Again, the coffee represents any products or service. And your asset is $40,000. Now, you might be wondering, how did you pay for the debt? Again, this is an income producing asset. And let's just say the income paid for the debt, okay, for the interest rates, for the interest payments. So now that you have this, the question is, can you afford the coffee? So let's just sell the asset and see what happens. So now you have a $20,000 gain. So that means you're going to pay 30%. We're going to assume 30% taxes across all scenarios. So now you have to pay $6,000 in taxes. And then you have to pay off your $10,000 debt. So how much are you left with? $24,000. So $24,000 after paying taxes and the debt, your coffee is $20,000. Can you afford the coffee? The answer is yes. So your purchasing power went up. Your purchasing power went up. Now, why did it go up? Why did it go up? Think about it for a second. Why did it go up? It could be one of 2 reasons. Either you used the debt, that's number 1, or because you bought 2 of these assets, or we could say more assets. So again, it's one of 2 things that have changed. Number 1, we used debt, or number 2, we bought more assets. So what we're going to do now is we're going to separate these 2 scenarios. On one side, we're going to test buying more assets and see what happens without using debt. And on the second scenario, we're going to use debt and see what happens again, and see which one actually worked, why our purchasing power went up from scenario number 1. So let's go ahead in scenario number 3, buy more assets without using debt and see what happens. So let's just say now we have $40,000 cash and our coffee is still $10,000. So we can afford now to buy 4 coffees. So with that, instead of buying 4 coffees, we end up buying 4 of the assets. So now we have $40,000 worth of assets. And again, these keep up with inflation. Now, after a few years, inflation has doubled, and now our coffee is $20,000. How much would the assets be? Again, it keeps up with inflation, so it's $80,000. So then we turn around and we sell the asset, and again, we have a $40,000 gain, of which we have to pay 30%. So out of that, we pay $12,000 in taxes, so we're left with $68,000. Now, we don't have any debt whatsoever to pay off here. So now we have $68,000. And the question is, how many $20,000 coffees can we buy? Now, keep in mind, before we were able to buy 4 of them. Now, with this, we're able to buy 3 and a little bit. So again, our purchasing power went down because before we were able to buy 4 coffees. Now we're able to buy 3 and have $8,000. So again, our purchasing power went down. What happened there? And the reason is, even when we bought more assets, our purchasing power went down after considering taxes and inflation. So let's actually look at scenario number 4. Now what we're going to do is we're going to use debt to buy an asset, but the asset does not keep up with inflation. It does not keep up with inflation. So let's start again. You have $10,000 and you have $10,000 coffee. Now, stick with me here. Hang on, because we're going to start revealing some really powerful stuff here. And you're going to realize that most people out there are doing the wrong thing. And that's all I'm trying to do here. And I'm trying to simplify it, because instead of giving you or making a statement, you will see it, and then we're going to talk about it mathematically. And again, this is just the tip of the iceberg. So instead of buying the coffee, you buy the asset, but you also borrow $10,000. So you buy $20,000 worth of the asset. Use $10,000 from your money, and you borrow $10,000. So now you have $20,000 in assets. But this asset does not keep up with inflation. So after a few years, your coffee now doubled because inflation doubled. Now it's $20,000. The asset, on the other hand, does not keep up with inflation. So instead of getting to $40,000, it underperforms, and it gets up to $38,000. Now, let's look at the numbers. So you sell the asset. Now you have an $18,000 gain. $18,000 gain, that means you have to pay 30% on the $18,000 gain. And then you have to pay off the debt. Again, how did we make payments on the debt? It's because this was an income producing asset. It paid the debt. So you sell the asset, and again you have a gain of $18,000, and then you pay the taxes, and so you're left with, and the debt, and you're left with $22,600. $22,600 after paying the debt and after paying the taxes. Now the coffee is $20,000. Can we afford the coffee? The answer is yes. So what happened essentially is that the purchasing power went up. The purchasing power went up. Why did it go up, given that the asset did not keep up with inflation? So before we talked about, there are two possibilities. One possibility is buying more assets, which we showed that doesn't work. The other side was maybe because we use debt. And in this case, this shows you that clearly it's the debt that improved our purchasing power. I'm going to say that again. It's the debt that improved our purchasing power. Now, why is that interesting? Because most people focus so much on the asset and buying the asset, and they don't realize that it's the debt that actually improves their purchasing power, not the asset. In fact, most people focus on, let's just say, real estate being the asset for now. They focus on the real estate or whatever the asset is, and they're like, let me just find some financing to buy this asset. And they're so focused on the asset because they think it's the asset that makes them rich. What I want you to realize is, I want you to switch the way you think about this and realize actually it's the debt. So the way you should be thinking about it is, how can I get the right debt and find an asset to encumber, but it's really having the right debt in your portfolio that improves your purchasing power. So start focusing on the debt, folks. Let's continue here, and then I'll come back to this here. Let's look at scenario number 5. We're going to use no debt. We're going to buy an asset that actually beats inflation. So again, you have $10,000. You have the coffee that's $10,000, and you have an asset that actually beats inflation. Okay, so you go ahead and buy this asset that beats inflation. So after a few years, inflation has doubled. So now your coffee is $20,000. The asset, though, is $22,000 because it more than beats inflation. It beat it by 10%. So now you have $22,000, and obviously you've done a great job buying an asset that beats inflation there. So then we decide, let's go ahead and sell the asset and see what happens. So you sell the asset, you have a gain of $12,000, which you have to pay taxes on, and that's $3,600 in taxes. So what you're left with is $18,400. That includes the gain after taxes and your $10,000 principal. The coffee, though, is $20,000. Think about that for a second. It's $20,000. Can you afford the coffee? The answer is no, you can't. Even when you bought an asset that beats inflation, you still, after taxes, and when you're considering inflation, your purchasing power went down. You can't even buy the coffee. And that is really to show you the power of understanding this information. So let's actually go ahead and look at the 5 scenarios we looked at. The first scenario, we said no debt, asset keeps up with inflation. Second scenario, we used 50% debt, and we said the asset does keep up with inflation as well. Scenario number 3, we used no debt, but we bought more assets. Scenario number 4, we used 50% debt, and the asset didn't keep up with inflation. It underperformed. And in scenario number 5, we used no debt, but the asset actually beat inflation. And here are the results. In scenarios 1, 3, and 5, where we used no debt, your purchasing power went down after taxes. In scenarios number 2 and 4, when we used debt, whether the asset kept up or didn't even keep up with inflation, our purchasing power actually went up after taxes. And again, the only thing in common is debt. And here's the result. Here's what we're trying to get to. Most assets do not make you rich. I'm going to say that again. Most assets, when you consider taxes and inflation, don't make you rich, meaning it doesn't improve your purchasing power. It's well-structured debt that makes you rich. It's well-structured debt that makes you rich. Folks, this is a whole different way of looking at things. Along with the right capital structure. We're going to explain what capital structure is a little bit later. But I want you to realize what's going on here. Most people out there are so focused on buying assets, but are not realizing that it's the debt or the well-structured debt that actually improves your purchasing power. Why do I say that? Because a lot of people out there are teaching you how to buy stuff, but they're not focusing on the importance of the debt. And if we lived in a vacuum where there's no taxes and there's no inflation, then the assets are fine. But we don't do that. We don't live in that environment. Our environment, our financial system has taxes and inflation. And as inflation goes up, it works against us. So let's talk about, and this is the agenda for this masterclass. I want to start with something that shocked you. So let's go over this agenda here, and let's start with the first section. Most people are focused on the wrong side. So let's talk about what that means. Let's look at the traditional method of investing. There's a formula here that's really important that most people don't realize exists. And most financial planners know about this, but they seem to never share it. And you'll see why in a minute. So this is B equals I divided by 1 minus R. Now R is your effective tax rate. So that's federal and taxes. I is inflation, and B is your break-even return before tax and inflation and after fees, just to maintain your purchasing power. Now, what does that mean? Let's plug in some numbers. Let's discuss it. So for R, let's plug in 40% for your effective tax rate, again, federal and state. I, let's plug in for inflation 6%. Now, most people think inflation is 3%. It's really much higher than that. You might want to go to shadowstats.com and look it up. But let's just plug in 6%, even though ShadowStats says it's higher. And the reason they say higher is because during the Clinton years and the Carter years, they adjusted the formula where they removed food and gas, and gas for a car. And so what happened is now you have it lowered the calculation to 3%, or the inflation to 3%. But the reality is it's actually more like 6%. So that gives you a number 10%. What does 10% mean? 10%, that means you have to make every single year a 10% return just to maintain your purchasing power, because now we're considering inflation and taxes. So out of that 10%, you have to obviously pay taxes and also keep up with inflation. So you have to maintain 10% every single year in a compounding environment just to break even, just to maintain your purchasing power. So think about that for a second. That means, again, for the traditional way of investing, which means no debt, and which means diversifying your portfolio and all that stuff, that means you have to make a 10% to break even. That is before taxes and before inflation and after fees. This assumes the investment offers compounding growth. Think about that for a second, folks. The return has to be consistent every single year just to maintain your purchasing power. That means if you make 11 or 12% one year, that's great, but you have to do that every single year. And again, all of that just to break even. You're not actually building wealth. You're not increasing your wealth. You're just maintaining your purchasing power. Give me one or two assets that do that every single year without using debt. And the answer is it's very, very, very difficult. Very difficult. And then they tell us you have to diversify your portfolio. That means if you put half your money into bonds paying you 2%, that means the other side has to make 18% just to maintain your purchasing power. So the traditional way of investing, which says no debt and diversify and all this other stuff, just doesn't work mathematically if you just follow these numbers here. It's pretty simple. So what does that mean for us? It just means, again, you have to invest in higher risk assets for the traditional way of beating that. Even if there's a way to beat it, it has to be a higher risk investment just to maintain that. So with that, let's look at this new approach of investing called the Wealth Q method. There's something we call the wealth equation. And the wealth equation is where you can be on one of two sides of the equation. So think of the equal sign, if you will, and there's the left side and the right side. So on the left side is what we call the paying side, and on the right side is the receiving side. Now on the screen you'll see I have four different what we call forces. There's actually a lot more, but I just give you four just to illustrate this. Most people are on the paying side of inflation, paying side of interest, paying side of tax and opportunity cost. That means as the government prints more money, for example, it's working against us in terms of inflation. And most people, again, are on the paying side of interest and opportunity cost. By the way, the biggest cost here is opportunity cost. Most investors don't know anything about opportunity cost, and I would Google it if I were you, but it simply means not using your money efficiently, because most people are putting their money in certain places where they could be putting it somewhere else and making more money. And if you knew how that works, that there's a huge opportunity there. Now, who's on the receiving side? On the receiving side, you've got the financial institutions, you've got the government, and you've got the ultra wealthy. And that's the key. They are on the receiving side so that as the government prints more money, they make more money. They improve their purchasing power. They're on the receiving side of interest. They know how to use their money efficiently. They're on the receiving side of opportunity cost. So how do you become wealthy? You simply move over to the right side. The people on the right side, as inflation is going up, it's benefiting them. Interest is benefiting them. Opportunity cost is benefiting them. But also they're lowering their taxes. They cannot be on the receiving side because unless you're the government, but the ultra wealthy know exactly what to do. And again, I just showed four here. There's a lot more. But the question is, how do you become wealthy? You simply shift to the other side. Now, here's an analogy for this wealth equation. On the left-hand side, think of you investing. And it's almost like you're flying a plane against the wind. So the wind is going against you. It's pushing you back. It's what's called headwinds. And so what happens is, as you invest more and more, the whole system, the financial system is moving you backwards in terms of inflation and interest and taxes and opportunity costs and all this other stuff. So it's moving you backwards. Now, if you flip over to the right side, as you invest or as you use the strategies we'll talk about, you are now shifting the whole system. So the system pushes you in the right direction. So now the winds, in this case, you're flying with the wind, what's called tailwind, and the tailwind is pushing you towards your destination faster. So you end up getting there much, much faster than the headwind. So, and that's what the whole wealth equation is about, and what we call the wealth Q. The wealth Q method of investing is simply about turning the whole system to help you move you in the direction. That's where the hacking of the game of finance comes in. How do you turn the system so that you don't have to work as hard and have it push you towards your goals? That's hacking the game of finance, folks. And that's what we call a debt millionaire who knows how to do this. So, if you want to be rich, again, focus on moving to the right side. Stop focusing on returns. Stop focusing on purely on the assets and on the returns, and start focusing on shifting to the right side. And we'll show you what that means. Shifting to the right side is the key to this whole thing. Once you shift over, the whole financial system is moving you faster because of the wind. And the secret weapon to move from the paying side to the receiving side of the wealth queue or the wealth equation is debt. And it's well-structured debt. It's well-structured debt. The wealth queue method was built from the ground up to work with our existing monetary system, where every dollar is printed and backed by debt, folks. This is how you hack the game of finance. You align yourself with the way the system works, and you make it work for you, and it moves you towards your goals. Right now, 99% of the people out there, 99.99% of the people out there, even investors and all that, they're working against the system. Why not just focus on moving towards the system, making the system work for you? And that is the key there, folks. That's why when I showed you these scenarios, I showed you how most investors think and how someone that can buy assets that even underperform in terms of inflation are still improving their purchasing power, because they understand how the system works. They used debt strategically. Okay, so we're done with the wealth queue, and we just introduced the wealth queue method. So let's talk about what is going on with people right now, because most people right now are really financial slaves to the system without knowing it. So let's dive into that. So we're going to start with the story of two investors, John and Jane. And John decided to keep investing the traditional way. Jane, on the other hand, decided to move to the right side of the wealth equation. So let's just see what happens after a few years of doing this. John remains on the paying side, and he sees himself making money. Just like in the scenarios, you were making money in terms of you buy the asset, it goes up in value, but you weren't really looking at the purchasing power. So what happens is, John, without knowing it, is working extremely hard as an investor or even as a working professional, and moving things to the right side for Jane. So Jane doesn't have to work as hard. And so what happened is, John is distributing or moving his wealth without knowing it to Jane. And Jane is receiving that distribution from John without John realizing. Now, she's not doing something evil or bad. She just understands how the system works, and she twists it and she moves it so it works for her. On the other hand, also, same thing with interest, same thing with taxes, and same thing with opportunity costs, especially opportunity costs. John doesn't realize that he's working extremely hard, and he works very, very hard as an investor again, and he doesn't realize that he thinks he's making money, but he's actually moving backwards because his purchasing power is actually going down over time. Jane, on the other hand, is receiving that, and without having to work as hard, and because she understands how to make the whole system work for her. So John becomes a slave to the financial system, and Jane understands how to use it to her advantage to work less and build more wealth over time. That's the consequence of not understanding this information, because most people will remain stuck in the paying side. So let's move on to the next item here. Most investors focus on the wrong thing. So I'm going to compare what investors focus on and what debt millionaires focus on. Investors are chasing returns, and that's one of the biggest mistakes you can do. Debt millionaires move to the right side. They focus on moving to the right side. Investors focus on assets. Debt millionaires focus on the financing in conjunction with the asset. So it is a combination of the right financing with the right asset. Investors focus on the assets with higher returns because they're trying to beat that break-even number. So they're always trying to have higher and higher assets, which results in higher risk assets. With debt millionaires, they're focusing on stable assets that are not high risk, not volatile, but low volatility. They're very stable, And that's why if you think about the the scenario where the investor bought an asset that underperformed in terms of inflation, but still improved your purchasing power, because they focus more on improving purchasing power rather than what beat inflation, because they understand it's the financing that makes them rich. Investors focus on assets that make you rich. That's what they're focused on. They're always looking for this next big asset. And debt millionaires are focused on and understand that it's the financing that makes you rich, and they're focusing on getting the right financing. Investors see assets and returns. That's all they see. What's the return for this asset, and let me go buy it. And debt millionaires understand the whole world of finance and how to make it work for them. So that was just a simple comparison between left and right, how the mindset is so different. So let's move on to the next item here and talk about how debt millionaires see things very few do. Hope you're all enjoying this. This is very powerful stuff. And again, my objective here is to shed light on where most people are wrong. In fact, most people spend a whole lifetime thinking they're building wealth and they're actually moving backwards. And I'm hoping that this will really change that for you and move you to the right direction. So again, hang in there all the way to the very end. Write these notes down, because this is changing the way you think. It's shedding light on really what's going on in the matrix, if you will, and very powerful stuff that you can use immediately by understanding how the system works. So let's move on to how debt millionaires see things very few people do. So I'm going to compare here two different scenarios: the old way of doing real estate and the new way of doing real estate. Now, on the left-hand side is the old way. So let's look at the old way. You have an arbitrage possibility. What is arbitrage? Simply means the spread. The appreciation is higher than the loan interest rate. So for example, if real estate, if it's appreciating at 5 to 6% and your loan interest is 4% or 3%, you have a nice spread that allows you to build your net worth over time. Again, appreciation is typically 5 to 6% for real estate. Your loan payments on real estate obviously must be paid. Otherwise, you will destroy your credit and you will you'll lose the property. The loans are mostly recourse. Your downside of the value, that means the value, there's no limit. The value of the property can go down. Now, it typically goes up, but there is no limit on how much it can go down as well. And a lot of us experienced that in 2008. It's tax deferred, which is great. That's a great tax advantage. The annual gains in appreciation can be lost. So in other words, let's just say you buy a property 3-4 years ago and it's been going up in value again. We talked about the downside. It can actually tank if in a bad market, and you can lose all the gains you have from the appreciation. And it's very location specific. If you buy a property in a bad area, or that happens to be in a relatively good area and then turns to be a bad area over time, it's pretty hard to do something about. On the right side, we're going to talk about a new way of doing real estate. Again, there's an arbitrage possibility where the appreciation is higher than the loan interest rate. So in this case, the appreciation could be anywhere between 7 and 9% average. The loan payments are accrued. And again, I'm comparing it to the left side. That means if you had to miss a payment or two, you're welcome to accrue it. That's how the lender gives you in this case. And they tell you, in fact, you can go for a whole year, in fact, 2 years if you need to, because the payments will accrue in case you're having a bad month or bad year. And you're welcome to make the payments, but obviously if things are bad, you'll accrue the payments and you don't have to make the payments, and you won't lose the asset. The loan is a non-recourse loan. Again, that means you're not personally liable for the loan. The downside of the value is guaranteed. Now, what does that mean? You cannot lose value. In other words, if the value of this property goes up, let's just say it's 100,000, goes up to 105, and then goes up to 108, and then goes up to 110, it can never go down, and it's guaranteed. It can never lose value. So it either goes up or break evens, but it never goes down. And all of it is tax free. If you know what you're doing, it's tax free. The annual gains, again, cannot be lost. So you buy this property, and after 5-6 years, let's just say it goes from 100 to 120 to 130. You can never ever lose. It can never go down in value after that. So at 120, again, it's either break even or going up every year, but it never ever goes down, ever. Now, why am I showing you this? I'm showing you this because most people think on the left-hand side it's about the asset, but on the right side they understand it's about the financing. And they've taken the same financing and applied it to the right side because it's a piece of paper that sits in your filing cabinet and it's not location specific. Now, what am I trying to do here? I used the term real estate, but it's actually not real estate. What I was trying to get to here is compare real estate to a piece of paper that if someone, a debt millionaire, knows how to do, and that's exactly what happens, the debt millionaires know how to mimic the same benefits of real estate without necessarily having the downside of real estate. But this piece of paper sits in their filing cabinet and they're getting the same benefits, almost the same benefits as real estate without owning it. Now, again, debt millionaires think about hacking the game of finance to work for them. And what they did here was they used debt strategically to improve their net worth without the actual asset being real estate, because they understand it's about the financing that makes them rich, not the asset. And that is just to really show you. I compared old and new real estate, even though it's not real estate, just to get the real estate investors on this training to understand how debt millionaires think. I wanted to show you a different way of thinking that debt millionaires have than real estate investors. Here's another one. Here's another way of thinking about it. John saves for retirement. He's been always debt free and pays off all his debt. He saves $100,000 at his retirement, and he's got $100,000 and he's done it all debt free, working very hard all his life. Jane, on the other side, doesn't have any money, and John now can buy one coffee that's worth $100,000. Again, it doesn't matter that it's coffee, it's a product or service, but in this case, he can buy one coffee. Jane, on the other hand, she has no money right now, but she understands the debt millionaire how to hack the game of finance. She uses the $100,000 from John to buy an investment that pays a little over inflation, and she uses the $100,000 as down payment. So again, she buys this $400,000 worth of assets. She uses $100,000 from John as down payment, and she gets a $300,000 debt. And this asset is very, very stable. Now, after a few years, the coffee or the inflation triples. And I'm exaggerating the example here just to show you what happens. But inflation triples because the government printed a lot of money, and so now the coffee is $300,000. Now, Jane's asset kept up with inflation or beat inflation by a little bit. So in this case, she has $1.2 million if it kept up with inflation, or more if it beat inflation. Now, Jane then pays John back his $100,000. Now, keep in mind, she's been paying him interest the whole time, but she paid him now his $100,000 principal after some time. Now, what happened to John's $100,000? What happened to his purchasing power? Now, he's excited because he got interest this whole time on his $100,000, and he felt, I made money and I got my $100,000 back after a few years. He's ecstatic. But what happened to his purchasing power? Now, the coffee is $300,000. He got back $100,000. Can he afford the coffee? The answer is no. His purchasing power went down like crazy, even though he thought he made money. Now, Jane understands, though, what happened. She improved her purchasing power significantly. John never realized what just happened to him. And folks, that's what's happening with most investors. They have no idea what just happened to them. Jane, on the other hand, knows exactly what happened, because Jane understands how the system works. She's a debt millionaire, and she knows how to hack the game of finance to work for her. Her net worth went from 0 to $560,000 after taxes, and she had no money initially. That's the power of understanding this. This is wealth distribution, folks. John is on the paying side, even though he thinks he's making money, but he's still on the paying side. Jane is on the receiving side, and she knows exactly what she's doing. I just wanted to illustrate here a few examples of how debt millionaires think and show you what's going on. Now let's dive into what's happening. Why is this happening? So this is what we call the third side. So many of you know that whenever you're investing, there are actually two sides. There's the capital, that's the money side, and then there's the asset. And I write about these in my book, The Wealthy Code, quite a bit. So imagine you have money on one side and you have an asset on the other side, and you decide, I'm going to get this money from people, OPM, and I'm going to buy this asset, okay? The key to wealth is the secret third side. That third side is actually the glue that ties the capital and the asset. And that, folks, is where the key to wealth is. Most people, again, think it's the asset side. It's not. Some people think it's the capital. It's not. It's actually the glue in between them and how you tie them together. And that's what we call capital structure. So if you notice here, you'll notice on the left-hand side, again, you've got the capital. On the right side, you've got the asset. But in the bottom, and that's the foundation to the whole triangle, is your capital structure. Remember that term, folks. I'm going to tell you what it is here in a second. That is where wealth is built. Capital structure is simply how an asset is financed. In simple terms, it includes how much capital is debt and how much equity, in very, very simple terms. It's actually the well-structured capital structure that moves you to the right side of the wealth equation. And that's what we're talking about here, folks. To move to the left side, to the right side, it's debt, but it's all within the right capital structure. What does that mean? If you have too much debt, even though too much debt might move you to the right side, but you increase your risks significantly, you have to understand how to hack the game so that it works for you. The question is, how much is the right amount of debt? And that's what we cover in the capital structure. How much should you pay for that debt? How much should you give for the equity? How do you structure it so that the whole portfolio is under, you're covering the downside, you're managing the risk, but it's moving you to the right side? That, folks, is so critical. And that's where the capital structure comes in. That's what a debt millionaire knows how to do. Again, a debt millionaire, this is about mastery of the capital structure. And the nice thing about it is that you can use it for any asset as long as you understand the characteristics of the asset. Is it income producing? Is it just an appreciating asset? Is it both? Is it highly volatile or is it low volatility? Is it stable or whatever? And so what happens with a debt millionaire, they understand how to get the right capital, how to structure it so that it works in combination with the right type of asset. So a debt millionaire is a master of the capital structure. And mastery of capital structures will help you understand what many investors are doing wrong, and it's costing them lots and lots and lots of money, and more importantly, time. And that's where the debt millionaire comes in. They excel in this, and they understand how to hack the game of finance so that it works for them without them having to do much work. So let's look at the measurable cost of not knowing this. Now, this is actually one of my favorite things. I called a number of people, 4 people to be exact, and I asked them what they've been investing in and where did they start 3 years ago. And they gave me different, where they started, dollar amount and where they are right now. And I scaled it down to $10,000. So here are the results of this. Now, different people invest in different things. Some people invested in CDs. Some people invested in real estate. Some people invested in mutual funds, stocks, different things. And here are the results we got. By starting with $10,000, and in 3 years, the first person ended up with a little bit over $18,000. The next person, $13,200. The next person is $10,005. This person actually put money in a CD, and the last person was $23,800. That's the result of the traditional way of investing. After 3 years, with $10,000 starting point. So we had a live event, and I shared this information with people and the debt millionaire. And I said, I want you to simulate. And they had spreadsheets and they had everything. And I said, I want to see what you guys come up with. And I shared all the information with them. And here is what everyone beat. Okay, every single person. And I've done this with 2 live events as a test to see if this actually works for them, and they get it. And in 3 years, I gave them $10,000 in a simulation to start with. And here's the result. Every single person beat this. And so here's what the result of that was. After 3 years, or in 3 years in the simulation, again, they only had $10,000 in the simulation to start with. Every person that was using the Wealth Key method ended up with $8,000 per month in income from assets, $300,000 in equity, and $120,000 in reserves. Every single person beat that. And there must have been at least 100 across 2 different live events. Again, I wanted to make sure they were getting it, and that's the result of understanding how to hack the game of finance. This is so powerful, folks. So what's the cost of not knowing this? Think about it for a second. You can remain in the system and think you're moving forward when you're moving backwards. Or you can learn how to use the system to work for you and move you faster. Investors lose money every single day by being blind to the system. The system is built to transfer your wealth to them and for you to be a slave to the system. And that is mathematically proven. Folks, it's time to open your eyes. A lot of people are running around and have very little to show for it because you don't understand the way the system works. You feel it, you can see yourself working harder and less over time because you don't understand the system. You need to open your eyes and learn how the system works and start shifting so it works for you. And keep moving backwards when you think you're moving forward. This is happening with everyone, folks. I see it every single day. People walk up to me and say what they're doing and they're excited. And it's just difficult for me to explain to them mathematically that they're actually moving backwards, but they don't understand. They think they're moving forward. So you can work hard all your life and make others rich while you get robbed without even knowing it. Or you can open your eyes. So what I did was I interviewed a few people that went to the live event, and there were so many of them, but I asked them, what do you think about the debt millionaire and what do you think people should know? So here's what people that took the training said about the debt millionaire.
Well, I feel the training was invaluable. I would have never believed that it was going to be what it was. I'm a managing director of a capital fund, and the training from this particular week that we're in opened my eyes, number one, to so many other ways we can structure funds that are, as we learned, even safer than the current fund that I'm managing right now.
I just attended the Debt Millionaire training, and it was amazing to find out how much I didn't know and how that knowledge deficit could potentially really be harmful to my net worth and future investing.
After numerous years, the majority of my life has been centered around law enforcement. The vast majority of my adult life has been centered around law enforcement. As such, I'm a very skeptical person when it comes to different views or different opportunities that are out in the world in investing categories. I'm very cautious, and my wife, as being a law enforcement officer, is also very cautious and very skeptical of the different opportunities available. We've been in numerous different trainings that never fit our criteria. And I say criteria meaning what we understood. We've been to stock trainings, way over our heads as far as our understanding of it. This training by itself, the millionaire training by itself, was just so phenomenal and so enlightening for me in particular, that it's given me the confidence and the abilities, I believe, to help us progress in our investment strategies into the very near future in building our wealth.
I would describe this training in one word as shocking, because I got shocked almost every day.
If I had to pick one word to describe this training, I think I would have to say freeing.
I think one word to describe the training was not necessarily one word, but a mind shift change. I really felt like my understanding changed more to a financier. And when I see very wealthy people and not understand what they're saying, now all of a sudden I understand, oh, there's a totally different realm that I'm not getting that I can see now. So it's hard to put that into one word. It's more of an understanding and a piece. Now I understand in a different way.
Very remarkable.
I would describe this training, it's awesome. You learn so many things here. It opens your eyes and look at the whole financial system in a whole new perspective.
The one word that I would choose to explain or this program is as eye-opening.
One word to describe this course is life-changing training. You will think completely different.
The one word I would describe this training would be enlightening, because I have learned so much. It's made me reevaluate how I've already done business and how I want to do business in the future.
I hate to use the word, I don't want to describe the training as powerful, because it's used so often in a description of it. But at the same time, I don't know if there's another word you can use. It truly is a powerful training, and such powerful knowledge, if it's implemented correctly, there's no stopping anybody from building their wealth in the future.
Life-changing.
The one word I would use to describe this training is paradigm shifting. It's almost like when I went out of the matrix. I think we all have been conditioned in our lives to do things certain way, to invest certain ways, to essentially take care of our money and future assets in a certain ways. I cannot go back and say where it's all coming from, but it seems like we all think in the exact same way. Even me immigrating from Ukraine, I came in here and I started researching on how do you manage money, and that's what I've learned. And now I'm going back and I'm looking at the numbers, and I really truly see that this is absolutely different way. We all had ceilings, we all had invisible boundaries that we've been bound by that we didn't even know we had. So that's, to me, is coming out of the matrix. So we are reloaded with a new program, so to speak.
Now I see, oh my gosh, it's going to set my family up, and this is something I can do now, and I didn't think that was possible. So it has given me hope of possibility. And then not only that, my family's protected, which is going to relieve a huge stress, and I can move forward with now these new strategies to implement to bring my worth up so much. And now but my underlying foundation will be set, which hugely gives me just release stress and gives me such hope in the future.
Hopefully you enjoyed that, and you saw what a few people out of many that have taken the training and what they're able to do. This shows you so much what's going on with the game of finance that my favorite quote, when someone stood up and said in front of everyone, they said, "George, this changes the game." And people were in a state of shock when we went through the training, because every day, like I said, there was something powerful and something that shocked them. And that's what this training is about. It's about shedding light on the way the game works so that you can do something about it. You can start using whatever investments you're using, whatever you're doing right now, you can change it so it works actually more effectively with the system. The key with this is that it's not about the asset, folks. It's about matching the right financing with the right asset. And maybe you might have to add one or two more assets, but the key is understanding how to use the system and the financing so that it works in conjunction with the financing system. Very, very powerful. And I'll tell you, once you understand this, you'll understand why we talk about the word or the term hacking the game of finance. You realize you become less about the asset and more about the financing. It's very powerful stuff. And that's where we have a lot of people that work together on moving to the right side and helping each other with financing and things like this. Very powerful stuff. So that hopefully showed you what's the cost of not knowing this. Let's talk about next steps here. For the people that want the next 3 steps, I'm going to give you the 3 steps you need to do right now. So the 3 most important things to recognize. So write these down. Number 1, you are the biggest asset. So what do I mean by that? Most people are out there looking for some asset out there, thinking, there's some secret asset that's going to make them rich. Folks, let me tell you this. The biggest asset that they know, they meaning the financial institutions and everyone else, is you. You are their biggest asset. And what I mean by that is they might use properties as collateral and all that stuff, but ultimately it's this thing called you, where we work for 40 years and we have ongoing income coming from us towards the financial system, towards the financial institutions. And so once you understand that we are their biggest asset, you have to turn things around and become your biggest asset, because stop looking outwards for some big asset out there that everyone is looking at, and start realizing that you are it. You are the biggest asset that the financial institutions know. Again, they look at properties and different things as collateral, but ultimately we are the biggest asset because we're the ones producing the income. So number 1, recognize that you are the biggest asset. Start focusing inwards and stop looking outwards. Number 2, when you recognize that, realize that knowledge is what makes you money, folks. Knowledge is what makes you and us, all of us, money. So the way you invest in this asset is by having more knowledge. So number 1, you're the most important asset. Number 2, it's the knowledge that we feed ourselves that makes us money. Okay, so that's really critical. And number 3, financing is where we make money. So this allows us to align with the system. So whatever investments you're doing right now probably requires financing. And it is in the key, in that financing, that's where we start making money. So what are the 3 steps again? Number 1, you are the most important asset. Stop looking outwards. Number 2, invest in you by gaining the right knowledge. And number 3, study financing and start making that work for you. This is where you make money, folks. These are the most important 3 steps you can learn. Debt Millionaire was created to elevate your game to make the system work for you. Debt millionaires are masters of using and managing financing. So let's talk about the Debt Millionaire training for those people interested in this information. Let's talk about what is covered at the training that you'll have access to. Number 1, master the skills to becoming a debt millionaire. Structure deals for income and growth. And you'll find out one thing about income and growth is that growth is where you make most of your money. Income is great for passive income, but as you have more income, your tax bracket gets higher. So you really want to, at some point, shift towards having more growth assets. Gain complete understanding of the Wealth Q method. Learn exactly what to do with assets you choose while managing the downside. So if there's an asset that you don't really like, and you want to change to something that's more paper-based, what I call filing cabinet wealth, you might want to then, you can pick, you need to know the characteristics of the asset, and you can use a different asset as long as it has the same characteristics. Learn to measure, manage, and control debt. You become a master of knowing how to manage and control debt and measure it. Make the financial system, meaning inflation, interest, opportunity cost, among other things we haven't talked about yet, work for you using any asset that you choose, again, as long as they meet specific characteristics. Learn to see the real financial matrix. When you understand how it works, you start seeing it, you realize how you can use it to work for you. How to structure all deals to be low risk as possible at 3 levels. At the asset level, portfolio, and economy. What I mean by that is every deal you do, so for example, you're buying an asset, you have to ask yourself, what does this do to my portfolio? Does it have too much risk in my portfolio? Is it too much debt for my portfolio? How does it align me with the financial system? What's going on in the economy right now? So you start thinking across 3 different levels. Get access to all the calculators for debt millionaires. We'll give you all the calculators that we use for measuring reserves, measuring debt, all that stuff. Stop wasting time and gain massive advantage over most investors out there. Learn how to build and structure your reserves, so it's so important. Gain access to self-paced training online for lifetime. This is for a lifetime, folks. You get to access it anytime you want, whenever you want. You can review it as many times as you want. Learn what your portfolio should look like for maximizing wealth while managing risk. How much debt should you have? How much income? How much growth? All that stuff you need to know about your portfolio. Do you have too much debt to income? Do you have this? Do you have that? You need to know all these metrics. Break free from financial slavery, the people that are stuck on the left side of the wealth queue. Become a master in hacking the game of finance. Folks, after this, you will understand what I mean by hacking the game of finance. You become a master of it. You will see things people are doing and you'll know exactly where they're going wrong. You'll know exactly how to change things so that it works for them and for you as well. Very powerful stuff. So the question is, are you the next debt millionaire? And it all starts with one single word: yes. It's that powerful, folks. So here's what you get with a Debt Millionaire Mastery. You get 2 courses. The Debt Millionaire Mastery, again, that's a self-paced online course. And you also get access to the Wealthy Code Masterclass. And that's the first class you want to take before you take the Debt Millionaire, because it's all part of the same big training. But you have to start with the Wealthy Code, understand debt, and then you move on to Debt Millionaire Mastery. And the whole thing is one big course in a way, but you have to start with the Wealthy Code because that builds the foundation, very advanced foundation to structuring deals for income, and then you move on to Debt Millionaire and take it to a whole new level. So the total is $2,294. However, we're going to give you a very special deal on this masterclass. But first, let me read the money back guarantee. If for any reason you're unthrilled and satisfied with our self-paced course, just let us know at the end of 15 days. So you have a whole 15 days to make up your mind, and we'll refund you 100% of your purchase price. Try it out, and you've got the whole 15 days to decide risk-free. Again, it's a very easy thing to try out because we're making it very simple. You have 15 days to make up your mind. So again, you're getting these 2 things, and you want to start with the Wealthy Code first. Go over that. Make sure you follow the exercises. We give you very specific exercises. Make sure you compare the answers. You understand why the answers are the way they are. And then once you have that done, you'll continue to the Debt Millionaire Mastery. So we're not going to give it to you at $2,294. The price is right below this video. And that's the investment for having mastery of the Debt Millionaire, of the way to hack the game of finance to work for you, no matter what your investments are. Here's something I want to share with you. People bounce all over the place looking for some secret investment. I see it happening all the time. One day they're doing this, one day this, one day this. But the reality is that they have to open their eyes to how the financial system is wired first. And that is where the secret is, folks. That is the secret. Once you understand it, you'll be able to say this doesn't work or this works because of the way the system works. So you need to open your eyes first, folks. Stop bouncing all over the place and learn and master how the game of finance works, and then learn how to hack it. Again, all of this you get, and the investment is below. And I'll tell you this, give it 15 days and see what you'll find out. You'll be blown away by what you're going to learn. One thing I want to say is, at this point, we're going to keep adding more content to the online course as well. So you already have so much content, and we've decided to add a few more modules over the next 2 to 3 months, so that you have even more information based on questions we're getting, so that this way you have all the information that you can always go back and review it. So over the next 60 to 90 days, expect to have more modules in there, but what you have there right now is incredible. And I can tell you that make sure you follow the exercises. Every module we have exercises, we have you doing certain things. Follow everything. Make sure you understand the answers, because it builds off of each other. And by the end, you'll be able to reconfigure your whole investments and approach things very differently, no matter what the asset is, but you understand the financing. That is so critical. And you will be well on your way to becoming a debt millionaire. One thing I want to say is about the investment. I want you to realize that this one investment can have you leap years and years forward into the future, because you're going to know how to turn the whole system to work for you. So realize, for this low investment, you're jumping way ahead. You're jumping way ahead to your financial goals, but in many ways, you're also doing things for your whole family, so that you move your whole family forward as well, and learn that you're going to get to your financial goals a lot faster. Most people have been bouncing all over the place, and they have nothing to show for it after all these years. How would you like to wake up 5, 10, 15 years from now and look back and say, gosh, I should have done something about it. I still haven't done anything, and I'm still where I am. Don't make that mistake. Look back after 2-3 years and tell yourself, I'm so glad I did this. Don't say, I wish I did it. Say, I'm glad I did it. Folks, this is such a low investment compared to what's possible once you understand this information. So with that, thank you so much for allowing me to share this masterclass with you. Hopefully it opened your eyes to what is going on and how you can leap forward ahead of most people. So with that, take care, everyone, and I hope our paths meet sometime in the near future. Take care.